The tariff thing, I think, will be lasting for a month or two, not beyond that.
There is no more, China plus one, I think, right now.
The fact is, it's a war. It's nothing else.
Very good evening to all of you partners, and thank you very much for joining us for the another session of Market Pe Charcha. It's me, Deviprasad Nair, Head of Business at Helios Mutual Fund, and with me I have Dinshaw Irani, CEO, Helios Mutual Fund. Always, it has been our agenda of discussing the events which are happening currently and which might be triggering some sort of reactions to the market. So straightforward, Dinshaw, just there's been a lot which has happened in last 1 month in terms of trade war, and the result of that, which we or maybe the world was expecting that would favor India, but hasn't been that. The outcome hasn't been that pleasing for us. Instead, it has gone in a very negative direction. Where there are being talks or rumors of sanctions coming in and so on and so forth. So what's your take on this entire, the chain of event, the way it is, happening, and how would that impact the overall markets, your market sentiment? While right now the market doesn't look to be that bothered about, but I think there is some kind of, negativeness which is still there in the market. So what's your take on that?
So basically, thank you for everybody, and sorry for the delay. There was some mess up on the back end as such, and that's why the whole event got delayed. But let me start off with this tariff war or trade war or whatever you want to call it. The fact is, it's a war. It's nothing else. Tariff is being used as a lever by US to negotiate their terms. Obviously, the countries which stand around their ground are being targeted specifically. And India is one of them. I mean, we stood our ground. We didn't bend backwards. We refused to allow them easy access to our agri sector, our dairy sector, and obviously the genetically modified crops that they want to bring in a big scale as such. GM specifically is a very big issue. I am sure the government would have relented a bit on the other factors if they were reasonable. But on the GM crops, it's a definitely no-no, because that makes our farmers totally hostages to international seed companies. Because normally, the present crop, the farmers normally what they do is they use their crop to set it as a portion of the crop to regerminate that crop in their fields. But with GM, there's no regermination. Whatever is produced are dead seeds. They are just for eating and not for regermination. So that is why the government stood its ground, and rightly so. Even the ones which went backwards for the US, what happened? I mean, let's talk about EU, one of the biggest trading partners who did a deal with the US. Why I'm telling you all this is that I don't think it made any sense for us to enter this, or rather to listen to the terms that US was laying down. So what did happen with EU? EU went backwards, allowed all US goods into EU territory at zero duties. And what did they get in return? A 15% duty is what they got in return. This is a far cry from the 3% that they were already in. 3 to 15 is a 5x jump. I don't think that was a good deal for EU. In fact, EU was the only one who agreed to these kind of terms. Even Japan, which is a 15% duty, the 19% duty was not that bad. Rather, 15% was not that bad a term which was used. They had a quota system for the cars imports and stuff like that, and that's why they could get away with this much. So what I'm saying is, Devi, is that 30% is the 50% duty is probably a very far cry. I don't see that lasting too long. Probably it'll come back to 25%. The 25% duty will go away. But even with that 25%, I don't see us doing much, because frankly, I mean, 25% makes it quite unviable for textiles. By the way, even today, of the overall exports to US, around 80 odd billion exports, 85 billion exports, around 40 billion is still exempt from duties by way of the health
Pharma.
and stuff like that. Pharma mainly, yeah. So that is exempt from duty. So it's around a carton of 4750 odd billion dollars, which is impacted, right? And 4750 billion odd is mainly textiles, precious goods, metals, and diamonds and stuff like that, which I don't know whether we need to, which will be viable even with a 25% duty, right? So that, set that aside. Secondly, what I was trying to imply by this $4750 billion is the fact that this is like 0.4% of our GDP, less than, in fact, overall less than 0.1% of our GDP as such. So I have 3% of our GDP as such. So I don't think it's a big issue here, right? Even if we agree work backwards, less than a percent of our GDP. So even if we work backwards, it's not going to make any difference to us. So I don't know, on the overall basis also, if you look at exports, that's nothing. It's like 4% of our exports as such. US, obviously, it's a big chunk of our, the 47 billion is almost 55% of the exports. But frankly, I mean, I don't see why there's such a hoo-ha. And you saw what happened to the market, right? 2.5%, 3% down for the whole month after a 50% duty. I don't see it to be a problem. By the way, Brazil, from the time those 50% duties have been applied, it's down some 0.6 or 0.7%. So even they're not bothered, right? And they were being applied this duty for some Bolsonaro case going on in Brazil as such. So I don't know why we are making such a hue and cry. I don't think that's the thing. Let's not be too carried away by what's happening in the US. They've exempted electronics. They've exempted pharmaceuticals. So I don't see a problem because these were the big two chunks which are being sent out. The rest all were obviously low value items. And oil and gas will go away with that duty with the war coming to an end, if at all it comes to an end in the Ukraine-Russia war. I think oil tariffs will go away at that 25%, and we'll be at 25%. So there's no issues, no hassles. I think the bigger call that one has to take is on, and actually you saw that resilience in the market also after that 25% announcement. The next day the market went up. In fact, the day after it was lower, but again yesterday it was up. And today again was 0.5% lower. So I don't think the market's taking a call here. I think the market's taking a bigger call on the performance of our corporates. Now the quarterly numbers are more or less out. Most of the corporates have reported. There are a few more to go. In fact, there's exactly 2 more days of reporting to happen before the quarter is over and done and dusted. So till date, the numbers are not looking that healthy. The growth is around 4% odd. And that is what we were calling out earlier also, that the excitement will only come if the growth rates pick up. Because anyway, the world has irritated us on the back of an excellent growth that one saw post-COVID. Pre-COVID, we used to quote at 17 times forward earnings. Post-COVID, we've now stabilized around 21, 22 times forward earnings. Even today, we're at 21.5 times forward earnings. But that was mainly because of the mid-teen to late-teen kind of growths that our earnings saw. This time around, the growth has been fairly sublime. In fact, the negative growth first time ever reported was in September quarter of last year. Then there was a single-digit growth, 3-4% odd in December quarter. Again, the March quarter wasn't that great. This quarter again looks like a 3-4% kind of growth in earnings for the quarter. So basically 1 year of downright bad earnings growth, and that is where the problem is. I don't see that also lasting too long. Frankly, I mean, if you ask me, I'm very hopeful that from September onwards, one will start reporting probably high single digit, if not double digit growth rates, low double digit growth rates in earnings from the September quarter itself. So the growth rate should kick in, and hopefully that should work.
Taking it forward from the growth part which you mentioned, Dinshaw. Now, so you're saying that that the corporate earning revival would happen, right? But but also the kind of impact which would maybe come because of the tariffs and all. What I sense is that would also take away something from the GDP, right? Overall, I think estimated to be about 60 to 80 basis point, I mean, on a higher side, and 40-50 basis point, or 25 to 40 basis point on the lower side. That's the estimation roughly. I think uh, the impact is anywhere going to be about 17-18 billion dollars is what out of the 77 billion dollars, which is basically is at stake right now in terms of the exports, right? That's the data. So you say that, so you are saying that the market will actually behave positive looking at the earning revival coming, even if there is a sort of impact on the overall country's growth. I mean, are we saying that, or right? I mean,
So basically, Devi, if I look at the World Bank estimates, right, it's around 30, 35 odd basis points that they've estimated, which I also, and that's I think is the worst case scenario, frankly, because I believe that we'll find ways of moving it around. Bangladesh is at what, 15% odd or so. So we'll probably move out some exports to Bangladesh and move it from there. US also is desperate. I mean, if you go into US stores, you see that they've taken off the labels from the Indian garments as such, because the prices are straight away up. $4.99 has become $7.99 or $6.99 and stuff like that. So it's becoming a problem for them also. I mean, inflation is obviously going to be a big issue if US continues the way it is. For some reason, they've all been dreaming that ultimately it is the country which is going to, I mean, on which they've implied tariffs is going to bear the tariffs, which is not the case. I mean, even Walmart has told,
which is importing would need to bear.
Look, we'll have to bear some part of that 25% tariffs or 15%, whatever. At least 7-8% has to go up for those kind of things. But right now, the public is, I mean, not public, rather the government is quite sanguine of this fact, and they're moving back. So I don't see this also lasting out. Frankly, I mean, the problem with these kind of tariff wars is they don't last for too long. And if they do, they're very harmful for the world. Forget India. Forget India's 30, 40 bips of impact. For the world, it will be a harmful one. Let me take you back to history and tell you the best time period actually for the world was from 90 to 20 to 1990 to 2020 was when the best growth in the world GDP happened. Why? Because there were no tariff barriers. There were no cold wars. Everything, the world was just enjoying itself. The cheapest guy won the game, right? So that's what it was. And unfortunately, that's being reversed because of the way Trump is looking at economics as such. So that's going to impact the whole world. So we're not going to be the only ones. If anything, we'll come out stronger out of this, right? And I think the weakest guy will be, I mean, the guy would be the weakest among all this will be the US. I have no doubts in that. If they continue with this kind of a policy, they'll come out the weakest. Unfortunately, the strongest will be China, who will come out of this. Because if anything, he's pushing everybody towards China. You must have realized that even India is now talking about tying up with China in certain fronts and stuff like that, because they know that this guy is much more stable than the US is. And unfortunately, after so many years of having stood our ground, we are supposed to do this is really unfortunate, but can't be helped. We have to go with a bigger power than US, and I think China is going to come out as a bigger power than the US. We already started issuing tourism visas to Chinese and stuff like that. I'm sure it will be easier for them to invest in India also going forward, obviously with some caveats tied in, which is the right way to go. I don't see that to be anything which will pull back India, if anything is at all. I think China will be a much more stabler partner than the US will be. So there will be give and takes. There will be obviously certain compromises that we'll have to undertake. But I'm sure it won't be with the US, because US is being very unreasonable. In fact, if you read statements of these foreign delegates and the other countries which have tried to negotiate with the US, they say they don't even know what they want, right? And in fact, if you remember, the last time we talked, I was telling you that even our delegates are telling us that who have gone across, that the problem is they can't take a decision on the table. You give them a proposal, and they said, we'll get back to you. And it has to be the top guy to sign off on that proposal. Otherwise, they lose the job. So that doesn't make sense, right? If you're letting out your people to go and negotiate, you better allow them to negotiate and not have the final power of veto power with you. So I don't think this is going to be a problem. My only concern is, will India get back on the growth trajectory, irrespective of what's happening in the US? Frankly, I mean, I didn't actually was too much of a proponent of China plus one playing out anyways. If you remember long back, both Samir and me were quite clear that China plus one is not going to play out in India, because now things are very different from what they were when China opened up. So that's why we never betted on these kind of stories. We're more betting on the domestic plays as such. And I think a domestic growth story is what has to pick up. And if that picks up, irrespective of what your exports are, where they are, it doesn't matter. I think we'll do a fantastic job going forward. One more thing I want to just again rewind and add to people's memories is that probably China and India had the same GDP way back in 89 as such. But since China opened up, they doubled their GDP in the next 10 years. But after that, to $1 trillion odd, by the way. So we quadrupled, their GDP from 250 to 230 to 40 to $1 trillion from 89 to 2000, sorry. And India just doubled it from 230 to 40 to around $500 billion. But from there on, China's touched, the GDP touched $20 trillion, $20.5 trillion, while we were at, by 2020, I'm talking about, while we were at $2.7 trillion. That gap which opened up was mainly because of the internal consumption which kicked in China. My feel is, in fact, our feel is, and if you talk to any economist worth his soil who's been tracking in India, all they feel is that India is at that cusp of where China was in 2000. So it's a matter of just time before things pick up. Unfortunately, the earlier governor went about sucking out liquidity to control inflation, and that impacted demand. But the current governor has been very not flamboyant, but very open to releasing liquidity in the system to improve demand. So I don't see that holding back. I think it's a quarter or two before demand kicks in, and that's when you'll see growth rates coming back in. So that's what I'm betting on.
So we are saying that there is no more China plus one. I think right now, the entire gaga was about that there is China plus one, for maybe not for us, while it was one of the key important things to look forward to, that China plus one. But anyways, the world wasn't requiring so much of capacity to, they don't have so much to absorb, right? When China did or expanded, to that extent, India also can't expand, right? Because there is no one to absorb that. So now where does this take us to? What is the new thing for India, from here? Because see, I think geopolitically also, there has been things that, geopolitically also it is sort of becoming negative. All this while there were 2-3 things which were there favoring India, while our domestic consumption was very, very important. It was there. I think that is not sort of seeing, there is sort of no improvement on that side. Then, we were talking about that geopolitically we are very strong. Then, China plus one was one of them, and manufacturing was one of them. Now, apparently, if you look at India, the trade balances which we run with China, and we end up importing a lot of stuff. So where are we directionally going as an economy? Maybe, do you think that it is like, 1-2 month thing, or, there is any structural change which is happening? What do you think, is happening or may happen? I don't know. I know it's very difficult for you to predict this, right? But I think, there were 3-4 big things we were talking about for last decade or so, which was one, obviously manufacture in India, which obviously we didn't sort of, talk about so much. But consumption, main issue I think is domestic consumption, Dinshaw, right now. So what's your take on that? Where do you see because we were thinking that by September or so we would see some green shoots on that front. So I think that's still not visible, right? And the second thing was that geopolitically we were emerging as a very strong economy, with a kind of a approach of that India first kind of an approach, that okay, we are good with everyone, and we will look at our welfare or our people's welfare, right? Now that is hitting us back. So where is all this taking us to?
So basically, they will. Okay, let me first tell you why we always believe the China plus one is not going to play out. One was obviously the reason that we were too late in the game. Secondly, by the time we came on as China plus one, probably it was at a very potent time because it was COVID had just happened. People are looking for avenues of outsourcing and stuff like that beyond China because supply chains were getting disrupted thanks to the massive outbreak that China went through. Right now, the thing was that we believed was short-lived because we knew that from there on there'll obviously be thinking going on that look, what if the same thing happens to India? You go from China to India or to Philippines or Malaysia, wherever you want to go to, or Vietnam for that matter. What if the same thing happens to these countries? So then the thinking came that, look, I can bear a 20% higher cost, but I need to be onshore or nearshore, right? At least the critical components, I will keep it nearshore or onshore, right? The low quality components which you can source from any other country, I'll give it to, say, probably India or to China now from here on and stuff like that. Yeah, not to China, but to Vietnam and to Bangladesh and all these places. So that's why we always felt that even the largest outsourcing play in our country, which is Dixon, what were the margins he's commanding? 3.5%, 4.5%, which is nothing. So basically, it's obvious that he's also surviving on low tech outsourcing, which is happening from India as such, and that's why he's playing only the bulk game and nothing else from here on. So that is what made us wary that look, this is not going to work for us, right? The PLIs all will work only for domestic consumption, not for outsourcing, and that's what has happened. I mean, you look at most of the PLIs which are being utilized are for domestic consumption. I mean, the exports getting substituted and Indian demand getting fulfilled, right? Secondly, why I believe China also will be keen to tie up with India is the fact that India is a $100 billion market deficit. Rather, we're running a deficit of $100 billion with trade balance, a negative trade balance. Obviously, that's huge. I mean, if you look at the next economy, like US is $600 billion, so we're not too far away. Though we're like, 1/4 the size of the US, but still we're running $100 billion kind of a deficit, rather 1/6 the size of the US. So we're still running $100 billion kind of a deficit. Now that will be exciting for China because they know India is a big market. So they will obviously look at not only exporting to India, but also partnering with India to access other markets because they have their labor issues. They have massive labor issues out there. The young people don't want to work in factories. That's why they have dark factories. And these dark factories come at a cost. There's a lot of capex involved. There's a lot of robotics involved. There's a lot of power consumption, energy consumption involved. So obviously they want to partner with other countries also. So I think we'll be better off tying off with China and utilizing that and probably moving some production to India. So that's the second part. The third part, as I said, we are an economy of probably, I mean, if you look at a very conservative basis, we are 1.5 billion kind of a population. But if you look at the actual consumer base, it's roughly around 45 million odd, 450 million odd people, right? 45 crore consumers. That is huge. That's like probably more than US, right? Put together, 35 million odd people in US, 33 odd crore people in US, and you're talking about 45 crore consumers. Consumers, please understand that it's consumers. EU's population is around 40 odd crore. So you can imagine the whole of the European Union in one single place consuming. It's a very exciting market. We are probably the only country with the youngest population. The median population is much lower than the world is. So we are yet to take off in a very big way. Our per capitas are moving up. And I have no doubt that they will keep moving up because the population growth has slackened off as compared to the GDP growth as such. So our per capitas will move up very sharply. And that's what is exciting the world. So I think we'll in fact, as that is why I feel that we will be coming stronger out of this mess than anything else. And as you rightly put it, the tariff thing, I think will be lasting for a month or two, not beyond that. But at 25% tariff, again, I don't see us having much advantage over the world in terms of supply to the US. at least in garments and precious stones, where the margins are very small. I don't see that happening at that 25% duty levels per se. So basically, I think we'll be more or less dependent on our own internal consumption. Now, the last point I want to elaborate out here is why we are so bullish on our internal consumption. One is obviously the base. September was the worst. Last September, rather, was the worst quarter reported with a negative 8% growth. This September, obviously, even if the June numbers, which are not that exciting, continue into September, you'll still see a 11-12% kind of growth, purely for doing nothing, just because the base was lower and this base is higher. That's why you will see a YOY impact coming through in terms of healthy numbers coming through, right? But my feeling is that already you can see that palpable demand pickup happening to an extent. I mean, you can see that the auto guys or the consumer durable guys are now pushing the pipeline because they've seen their inventory getting picked up quite appreciably. No growth are not happening still. I'm not calling out a growth, but the fact is that they're seeing that, and this is what you realize after talking to quite a few corporates and stuff like that. Yeah. So there's some early signs of green shoots happening in the urban demand cycle. By the way, the rural demand had a problem, but started improving from the beginning of this year. So rural is not a problem. It's now the urban, which is the issue, and the urban is a big issue because that's where the real discretionary, big ticket discretionary happen, right? So that's why the urban pickup is what is to be looked at. Now, let's see what RBI did. RBI, the earlier governor, as I was saying, was more keen on controlling inflation. And the best way he knew how to do that, because you couldn't raise interest rates any further, the world was cutting. So we could have increased interest rates. So he started off by sucking out liquidity from the system. When you do that, you basically ensure that the consumer doesn't have money to spend. If he has to borrow at a higher level to get that money, right? And that was what he was trying to do, and that's why he was trying to curb back consumption. With the new RBI governor coming in, I think the first mandate that he had was to get demand back on the road. And that's why he started by infusing massive amounts of liquidity into the system. By the way, as I said last time also, that earth-shaking 1% cut in CRR, which will start impacting from September onwards, and the fact that he cut off 0.5% in interest rates, I've never seen an RBI governor doing that together. It's been in phases, but never together. So basically took it as upon himself that I want to shake the system and make them believe that we are there to support. And as I said, that if liquidity is enough and it's at a cheap level, consumers will come. Basically, liquidity is like this fuel which has been thrown around and it's just waiting for a spark to happen. My belief is the spark will come by way of the festive season, which will kick off with the starting of Ganesh Chaturthi, which I believe is in August. So I don't see much time here. I think the pickup will start from that end, and the whole festive season should see a healthy growth coming back in. Now, if December picks up, the quarter of December picks up, then you're again talking about from a 11-12% growth, you're again seeing healthy growth in December. And that is what the world is waiting for. And that is what the private sector also is waiting for, because once they see that demand pickup happening, they will start building capacities. When they build capacities, job creations happen. Job creations happen. Consumer comfort comes in. Consumer comfort comes in. He spends more. If he spends more capex happens. So it's like a spiral which keeps moving up, right? So that's what I'm waiting for, and I think that is how it will work.
Yeah, and also, I think the FIIs would also be, eyeing on, because there's been questions, that when will we see that money flowing back, right? Or FDIs also. I think it's all interlinked. I think, they need to see the growth coming in, and this is something which we've been expecting also, that, I think quarter September end onwards, or maybe as we run up to the festival season, I think we should see some thing improving, so coming back to Dinshaw, on some of the bets which we had taken. So tech we had taken, we had exited in Feb, and what's your take on that now? What are we making out of tech as a segment, and from here way forward, which are the 2-3 pockets where maybe we can expect returns to come from if you can share that with our partners.
So basically, you're talking about tech, right, Devi? I mean, wow. So basically, our call has proven right on tech. I mean, our concern on tech was obviously it stemmed off with AI, because AI all along we thought was going to be a addition, or rather it will be helping out, assisting IT in information technology companies. But what we realized somewhere down the line was it was taking away from IT companies. The IT sector in India for the last 30 years has been purely working on now 35 years. It started off in the early 90s. So almost 35 years now, 3.5 decades that the sector has been around. The main formula that was used by the sectors was the number of people into hours spent per person into the rate per hour. That was the kind of formula that was being used. With the AI coming in, and obviously the number of people have shrunk, the hours being spent per person also has shrunk. And I don't know how much is the third leg of the equation, which is the rate per hour, which is going to increase to compensate for that. That's definitely not going to increase. If anything, if they keep the first two legs constant, the third one has to then shrink, right? So that's why the concern was. In fact, today only Washington Post came up with an article that how the Purdue kind of graduates, postgrads who've done computer engineering and all are working in Chipotle and stuff like that in US. So you can imagine that they were being told that this is the rosiest way of finding a job, and unfortunately there's no need for new programmers now going forward. So that's where the concern came up, and that's why we took a call that we don't want to be in IT. And all along we've been telling everybody that, look, the June numbers will prove us right, and they did, right? I think the euphoria in the April to June quarter was that there was money lying around by most of the fund houses. They didn't know where to deploy that cash. They'd seen the IT correcting and maybe they picked up IT. I'm not sure. I mean, that's what the numbers were showing me. That was mainly money moving into IT, idle money moving into IT, which propped the stocks up a bit. But you saw what happened after the June numbers came out. They've corrected. And frankly, I don't have any hopes right now. Firstly, is because of AI, which is a gray area, but our feel is that it won't work out on the benefit of the IT companies. They'll take a while for it to understand. If you remember during the machine learning days, ML, when it caught on, autonomy caught on, that time also we took probably a year and a half to understand the ropes and then came up with some options here. But AI is a different animal. It's not that easy to understand. So it'll take us a longer time to understand. And probably we'll earn out of it, but I think it'll be a while. Secondly, US, which is going through these hums and haws, I think that is what is impacting the demand for IT guys. Most of the IT guys will declare the numbers, and most of them have declared the numbers. They came up by saying that, look, it's taking much longer to close deals, and even if they've closed the deals, it's taking much more longer to commence those closed deals. So it's obvious that there's a lot of uncertainty in the US, and that's why IT is a complete no-no for us. We will be away from IT at least for a quarter or two again, having reviewed what's happening, and then probably take a call. By the way, nothing goes to a zero in this market. You always keep your minds open. And that's why I think Helios is where it is today in terms of performance. We never have a love-hate relationship with any of our stocks. We always have our minds open to any opportunities which come by. So
there's always this fear and this question with which, the investor or the distribution partner on the equity side lives with, because the moment, there is something happens, what you see is that you're flooded with, asset allocation messages, and then, and then, also multi-asset, and all that. While, on long run basis, everyone knows that equity as an asset class has delivered far better return and greater return than this. So how do partners, maybe deal with this kind of, seasonal fear mongering which happens, Dinshaw? I mean, there has been fear mongering which happens, around small and mid cap, that sells small and mid cap and exit. Then, if something happens somewhere, then, again, equities, because valuations are looking stretched. All this while we had a comfort saying that as a country, as an economy, directionally on all fronts, we were doing very good, but some bit of slowdown is there on that front. So valuations time and again get questioned. So what's your take on this entire thing, that, equity as an asset class also right now, and then valuation, then within that, the small mid pocket, right, which is, more worrying to the investors and distribution partners in general.
So basically, Devi, the fact is that equities is by far the best class to be in. I mean, you can have phases where you'll see some precious metals outperforming. This was the phase which happened. I mean, with the humming and hawing of the US, no certainty, obviously too much of risk in the system, gold outperformed equities, right? But that I believe is in a phase. It's, if you look at the longer term, equities definitely outperform any other asset class which is available in the market, and that's why we are true believers in equities. One, secondly, I mean, the equity from a economy like India, obviously you're talking about double-digit growth over a longer period of time. And I was just looking at the numbers. I think the 10-year growth is around 15-16 odd percent. The 20-year growth is around 14 odd percent and stuff like that. And I'm talking about index, right? Not anything else but the index. So you can imagine what an alpha manager can do for you, generate another 3-4% extra, which asset class can give you a 17-18% kind of return on a consistent basis over 20 years. Not possible at all, right? So it can only come from equities, and that also a growth market like India will be the right market to be in. Yeah, if you were in the US, I would have told you to probably invest in debt or go and buy some real estate where the yield is some 0.5% or so and stuff like that. But definitely not in India. Equities is the way to go. So that's why we not, at least in the immediate short term, you won't see a multi-asset fund coming from our chain, because I think we think equity is the best way to go forward as such. So that's one which is very clear about. Secondly, in terms of valuations, there's always a push and pull, right? I mean, as I said, that pre-COVID, we were 17-18 times forward earnings. Today, we are 21-22 times forward earnings. We had a peak of 25 times forward earnings also, right? But that was, I think, more of froth than anything else. The future was getting too far out discounted. I think that discount has come back to around 21-22 times forward earnings, which is a very reasonable PE. Coming to the specifics of large, mid, and small, large is never a problem. Large, I don't think, has an issue at all. Because if anything, India's balance sheets have become stronger in the large cap space. And as a result, large caps deserve the premiums that they are quoting at today as compared to their respective PEs in the past, right? Coming to the small cap space, I'll take the most controversial one in the last small cap space. I don't see a problem there also, because small cap, unfortunately, when you look at the PEs of 30 odd times forward earnings, you're looking at PEs which are only of the 250 companies which are there in the index. Small caps is an ocean beyond those 250. I mean, there are 4,000 odd stocks listed in the Indian equity markets. Anything beyond those 250 are up for game as small caps, right? So you have to look beyond that, and that's why you will get justification. You saw what our small caps have done. We've been early on to certain names which are there. I mean, I don't even want to talk about them, but you can see the performance in our portfolio of these names as such. And one particular gentleman,
I see that really are desperate to do our small cap fund sometime very soon. And then when we get final approval from SEBI, just launch that. Yeah, I do see that.
Yeah. So anyway, and that also we'll time it accordingly. I mean, when we see that
exactly
euphoria coming back, we'll probably try and time that according to what we feel is the best for our investors. The way we timed our mid-cap fund.
I mean, absolutely. Yes,
phenomenal. Do that. Okay. So, so that's on the small cap bit. And that's why I said it's an ocean. There are enough ideas out there. Coming to the mid-caps, which is unfortunately limited to 150 companies. That's where the real issue is. But even there, if you take out the top 30 companies of this 150 or 35 companies, if I'm not mistaken, where the Ps are obscenely high, like 100 times, 80 times forward earnings, you remove those and you then look at the remaining pool of 115, 120 odd companies, the Ps are quite reasonable as compared to their growth. So that is where one has to concentrate on. I'm sure if money flows into mid-cap, those also will start looking a bit frothy going forward. But my belief is that these are the ones which will be really moving towards a large capish kind of a scenario pretty shortly as such. And that's why I believe that there's enough there also left in the pool. In fact, in our mid-cap fund, we're very clear that we will not have a single large cap in that fund because we want to show it as a high alpha, high beta fund. And that's why you'll see a mix of only small caps and mid caps. Obviously, you're not allowed to go below 65% mid caps because of mid cap fund. So that's why 66 odd percent of mid caps and the rest will be small caps. Unfortunately, there's only one large cap, which was a mid cap but turned into a large cap in the recent classification. So that's why it's become a large cap. Otherwise, by the way, there were two more which were classified as large caps, which we moved out of and moved into mid caps after that. So I think that's where it is today.
Before I think most of the questions I've taken. If there are any more questions, I would request participants to just type in the Q&A box. I will be taking that after this question, Dinshaw. So Dinshaw, one more thing that also another set of people are sort of advocating that now there is no don't put entire money in India. The world is growing. Take your money out, go put it in US. You are consuming US product, right? You are consuming Chinese product. So diversify, go and invest there. What's your take on this bit? If you are using Apple phone, he makes billions of dollars out of India, right? Does it make sense to chase that? Is it the right way to look at that? Because you buy the product, you should go and invest in a US market, to benefit from that.
So basically, you're saying that just because the brand is there, you should invest in the brand as such, yeah?
If it is, if it is like the things are that.
So if I take a path with Unilever soap, I should be only buying Unilever. Doesn't work. Frankly, I think the guys who make money, if that was the case, China would have never come up the way it did. China, in fact, was the sourcing base for the world, right? But as I said, that they started off sourcing at the time when it was really needed. If India had opened up at that point in time, in the late 80s or early 80s, when the world required it, we would have been no different from a China. Our technological advancement would be as good as China because they benefited due to this technological transfer which happened because people wanted cheaper products, right? So they were keen to transfer on the technology and they capitalized on that. In fact, I was looking up somewhere that R&D spends in China are roughly around $750 odd billion, right? Annualized. US, by the way, is $850 billion. India, it's nothing. It's around $60-70 billion. And that also, private sector R&D is pathetic. It's hardly anything. In fact, the largest private sector capex is by Tata Motors, which is around $5 odd billion. And that also, excuse me, that also is because of JLR and nothing else. They're not spending on Indian R&D. So I think that is where the disconnect happened. And that's why China, the product that they brought on was because of this, like BYD and all was. It's an offshoot of what they were doing for Tesla and stuff like that, right? So that's why they picked up from there. Unfortunately, I don't see India doing that in a rush. We'll take a while to do it, but we'll also be there at some point in time, but not today, not at least the next couple of years. So I think that is the wrong way of looking at it. Obviously, the world chases growth. Wherever the growth comes from, that is what they will look at. China, unfortunately, there's no growth. Despite the technological advancement, there's no growth. In fact, their economy is deflating because of the fact that the consumption is going down there. The youth is not ready to work in factories out there. So they are coming out with these dark factories and stuff like that. So that's where the compression is happening. And that's why that deflator, which is happening in China. And the only growth economy that one can look at is probably a Vietnam or a India or a Philippines and stuff like that. And the amount of money that India can absorb, none other can absorb to that extent. Obviously, the global flows, they can't be in one single market. They have to move to other areas which are looking much more growth efficient and stuff like that. By the way, US, which was a discount to India earlier, has become a premium to India thanks to the kind of money that has flown into there. So it's obviously a matter of time before people start looking at outer markets also going forward. So I think I don't have any doubts that India will grow despite the fact that there's no global products for us to offer as such.
So there's a message from one of our partners congratulating the entire team on the stupendous performance delivered in FlexiCap. But let me just share some bit more with the partners that it's not only FlexiCap, it's mid-cap, it's large and mid-cap. Across the product basket, across the product basket, the performance has been stupendous. But obviously, congratulations to the entire investment team for the kind of performance numbers we have. And it actually gives partners a lot of strength to take the product to every house or every customer they deal with, and sell or advise them confidently to allocate to our fund house and our products. Before we wind up, then show one question which is there, that there is always a relative comparison which happens, right? So China and India, Zomato. I have just one liner on that, while you can dwell further on that. It's on Zomato, but I have one liner which explains is that every country has its own story, right? Like every human being has its own story. I mean, I think every country has its own story, and the further detailing of this is that India, what we've been talking about internally also, that the way Indian consumer consumes, or the kind of infrastructure and other things are there, that also plays a role in a company succeeding in another country and not in your country, or in your country and not in other country. I would request your take on that bit, Dinshaw, on companies which have failed externally, like in US or in China and all, but have succeeded in India. So and they trade at obnoxiously high volume valuations also, as per but I believe that they deliver that kind of a growth. That's why they trade at what they trade at. But your view on that?
So basically, I saw that question. So Meituan is the company which is in China, which is probably what Zomato is in India, is a Meituan in China. That company holds, I think, around 67-68% market share in China. When they started off, they were not a hyper-local company. They were also a food delivery company, the way Zomato was. But today the mix is, I think, 70% is hyper-local, which is your quick commerce, 20% is food delivery, and 10% is new ventures as such. The mix is totally opposite for Zomato. It's 70% food delivery still, 30% hyper-local, 30 or 35%, 34, 35%. And the rest, I mean, some 2-3% of new, not even 2, less than 1% of new product offerings as such. So that way, I think that reversal is yet to happen. And I think the gentleman said that why is the valuation so cheap out there and India so high? Because of growth rates, period. Secondly, look at the concentration of population in China. The whole of that eastern belt accounts for some 80-odd% of the population. It's highly concentrated in one single block as such. So there can be hardly any penetration out here. Look at India, it's totally widespread. There's no single block which accounts for the bulk of the population, right? Each state has its own. So the market is huge, and so is the potential for growth. And that's why we believe that in India, the growth is going to be much more bigger than what was in China per se. I don't have any doubts about that. And that's why the way it is. In fact, all these platform companies are, I think, what differentiates India from the world right now. As such, you ask me what models have worked in India. This is how it has worked. And I think we have very technologically savvy. The fact that data is very cheap out here has helped in these companies to grow the way they have grown. And I don't have any doubts that in the future also they'll keep growing the way they are until they hit a penetration level of some 30-40%. I don't see that to be a problem at all. Passive funds, the only thing that goes in their favor is the AMC charges are very low. The charges are very low, right? The fixed fees are very low. And I'll tell you why the fixed fees are very low. First, I'll tell you that. And secondly, I'll tell you why what you see a return in the index is not actually what you'll get in the ETF. These are two things I want to prove to you. Okay, the fees are low, mainly because it's a passive fund. The moment an investor decides to invest in a passive fund, that investor becomes the fund manager, and the passive fund manager becomes just a broker. So he's just charging you his service fee for brokerage and nothing else beyond that, right? So that's why they're cheap. He's not a fund manager. He's just a broker. He's executing orders on your behalf, period. That's how it is, because you already decided that these are the stocks I want to buy. So that's why the difference, the major difference of low fees, right? He's not earning his worth, okay? So that's why. Secondly, why a passive fund will give you a much lower return as compared to the index. Activist fund is supposed to give you a higher return than the index, but a passive will always give you a lower return than the index because they are tracking the index. So normally when the stock falls, they will sell the stock to compensate for the weight. And if the stock rises, they will buy the stock to compensate for the weight, right? So basically they're selling lower than the index and they're buying higher than the index. So there's always a tracking error. That's one thing. Secondly, please understand, index never has a brokerage. For the stock to fall or go up, there's no brokerage applied. They don't have to pay a STT. But when the ETF executes a trade, they have to pay an STT of 12 paisa and probably brokerage of another 8 paisa. Every single trade will cost them 20 basis points, right? So that's where the differential lies in this. The third thing is that it's an ETF. You're not buying the index. You're buying an exchange traded fund. There's always a discount to the ETF as compared to the underlying index. So you'll see a massive disconnect between the return of the index and that of an ETF. And that's why I believe it's a not only a tracking error, but all other things that I talked about. So please don't know for me.
And then watch out to our channel on social media channels for Mythbusters. This is one of the thing which is coming up very shortly in terms of, so watch out for that on our Twitter, where we're gonna talk very briefly or very crisp data points about this myth of active versus passive, right? And with that, I think we come to an end of today's Market Pe Charcha. I really thank Dinshaw for taking time out for joining us on this session, and also to our partners. Thank you very much for joining us for this session, and we look forward for many more months of Market Pe Charcha together. And thank you very much for making us. We recently crossed 5,000 crores on our equity AUM. So thank you very much for that. And many more, many more thousands of crores to come, for Helios Mutual Fund. And thank you very much for that. Have a nice evening, and long weekend is coming forward. So you have a nice day. Thank you very much.
Thank you, everybody, and thank you for the support once again. And take care and all the best.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.